Nifty lower by 40 points. But let's put these questions forth to our guest today. Gautam Baid from Complete Circle Stellar Wealth PMS is joining us now to discuss the market fundamentals and his stock sectoral picks as well. Gautam, good morning. Thank you so much for joining us. Always a pleasure speaking with you. You know, as Surabhi was just pointing out, maybe markets are afraid of the highs now. There's a fear now in terms of higher valuations. We are seeing the support only coming from Nifty IT today so far. But in the broader markets, what is your suggestion? Because most of the stocks have rallied, do you think there is still some steam left, or now investors should be a little careful in that space?
Hi Sonal, hi Surabhi. Thank you for having me on your show. You're absolutely right that the valuations of the good quality growth stocks in the broader market have become very expensive. The markets have obviously rapidly factored in the continuity of the policy of the current dispensation. And from here on, one needs to be very selective and have a bottom-up approach and focus on those stocks which are having very strong earning visibility and enjoying sectoral tailwinds. Because if and when the market does experience a correction in the future, the stocks which are basically just going up on hope without really any strong earnings to back them will fall the hardest. So now is the time to actually make use of this rally to consolidate your portfolio into the stronger names and high quality stocks. That is the strategy from here on.
Okay, Gautam, hi. Always great to have you on our show. So we were looking at some of the picks that you have in mind, at least stocks that you are looking to own. And I want to start with ICICI Bank, and that's really interesting, right? So anyway, banks have seen some interest come back after a long, long time. But I'm wondering why you're going for, say, an ICICI Bank specifically and not with the other market favorite, which is HDFC Bank, because there's so much chatter around whether that FPI headroom sort of increases, and if they get added to the MSCI indices, if the weight goes up, then anyway, there's like billions of dollars waiting to flow in the stock. So just technically, the stock could rally. But despite that, on a fundamental basis, you're going with ICICI Bank. Why is that?
Well, so the time to buy a well-managed franchise is when the entire industry is out of favor with investors. And most of the private sector banks in India today are trading below their long-term price-to-book mean multiples. And there are four key reasons why this has happened. Why this entire pack of private sector banks in India have undergone a derating over the last 3 years. The first big reason is competition from public sector banks. So between 2010 and 2020, there was negligible competition from the public sector banks because they were beset with asset quality issues. But once they became strongly recapitalized, then we have seen in the last 4 years that the private sector banks have faced increased competition from these public sector banks. The second reason for the derating of the private banking space has been net interest margin compression. As people have taken money out of bank fixed deposits and moved more into the capital market side, the banks are in an increased competition among themselves to increase deposit rates, and that in turn has pressured the net interest margins. The third factor which has led to the derating of the sector is regulatory action. So if you look at the RBI actions against Paytm Payments Bank or against Kotak Mahindra Bank, then those regulatory actions have further soured sentiment of investors in the financial space. And fourth and very important technical reason is that over the last 3 to 4 years, we have seen billions of dollars of FII selling. And as we know, financials and especially private sector banks were one of the largest weightages in foreign investor portfolios. So that intense selling also led to derating of the sector. However, you are getting a very well-managed bank with negligible net NPA. The FY26 net NPA for ICICI Bank is expected to be below 0.5%. And you're getting this bank at a price to book multiple of less than 2 times on FY26 basis with return on asset above 2%. So I think the only key risk to monitor here would be any increased stress in the unsecured personal loans and credit card portfolio of the bank. But other than that, I think this is the time to actually go in for this particular franchise. And you also mentioned HDFC Bank a while ago. Here I would like to mention that ICICI Bank is far better placed compared to HDFC Bank when it comes to the credit to deposit ratio. The unsaid or implied mandate of the Reserve Bank of India is for these banks to bring their credit to deposit ratio below 80%. As of today, HDFC Bank has got a credit to deposit ratio of 110%, whereas ICICI Bank has got a credit to deposit ratio of just 85%. As a result, HDFC Bank will have to increase its number of branches to increase the deposits, and that will put pressure on its cost to income ratio. And they'll also have to increase their deposit rates as well. So that will lead to suppressed net income growth. So that way, ICICI Bank is much better placed.
Okay, got it. Thanks for the perspective. That really answers my question. I was wondering why not HDFC Bank, but it's that CD ratio that you have on your mind. So we'll keep it on our mind as well, Sonal.
Yeah, but Gautam, I just want to understand also now, from here on, do you think money will move completely or mostly from PSU banking space to private banking space? This is something the investors will focus on from here on?
Well, I don't think there'll be a wholesale shift from the public sector banks to private sector banks, but right now you're having many of these public sector banks trading at a premium to private sector banks. I think the corporate governance or the governance risks and the regulatory and the political risks still exist in the public sector banking space. So this discount which the private sector banks are now trading to their public counterparts, I think it's unjustified, and that gap should narrow. So that will lead to some extra alpha generation for investors in this private banking space, in my view.
Okay. Gautam, what else? I mean, so we've spoken about banks. Before we get to your next idea or the next company that you like, just a word on IT, because that's today's flavor. Everybody's trying to sort of read between the lines on Accenture's numbers and figure out if the turnaround is around the corner. You know, IT stocks are amazing because they've had fantastic trading bounces and trading rallies when none of the companies so far are going out there thumping the table and saying, hey, demand is coming back. But it's just, I think, interesting market positioning that we've got going. But what do you think, and what is your sense on IT?
Well, Surabhi, we often see, like today, for instance, the Nifty is in the red. Whenever the markets go down, IT tends to do better. Also, yesterday, the Indian rupee touched an all-time low versus the US dollar. So it's more of a tactical move, in my view. It's more of a short-term trading bounce, and because a lot of traders and algos basically they just monitor the rupee dollar exchange rate, and then they make their short-term position. So I think we are just having a tactical bounce, but there is no strong demand uptick as such in the IT services space right now. There are so many pockets in the market today which are promising you 20-25% or even higher growth rates. So why go for single-digit growth in such a raging bull market? You want to be in pockets where you get very, very high growth, because you get rewarded very handsomely for backing high growth in a bull market.
Okay. So that's about IT. The other stock of the pick that you like is Ethos. It's a play on the luxury market as well. We've spoken about how post-COVID luxury market has seen a one-way move. Tell us first, why do you like this particular name in that segment, in the consumption segment? And what's your take on consumption in general? Do you think that could be the theme going forward?
Well, consumption has been an evergreen theme in India for the last few decades. But as of today, rural consumption, has been a bit slow and been struggling actually over the last 2 years. But there are clearly green shoots visible. If you look at the commentary in the conference calls of FMCG companies and consumer staple companies like Dabur, Britannia, HUL, it was very clear in the March quarter itself that rural India was beginning to heal. And now with this recent coalition government mandate, I think the government is going to put an increased emphasis on boosting rural consumption and boosting the incomes of the rural population. So you may see a further uptick in the two-wheeler auto ancillary names, as well as the domestic agrochemical companies. We are already seeing the market starting to factor in the improved prospects in those two areas. But one theme which has been in vogue for the last decade is premiumization, and especially the upper end consumption in the industry. So the luxury market in India is expected to expand fivefold over the coming decade. And Ethos Limited, in our view, is one of the best premiumization plays in the listed space in India. The company has given a very strong store expansion guidance. As of May 2024, Ethos has 63 stores in 24 cities in India. And the company plans to add 25 new stores in FY25 with a total store count guidance of 150 in the next 5 years. Now, most notably, this company offers you scope for margin and ROC expansion along with revenue growth. And where will this margin and ROC expansion come from? It will come from 4 key factors. Number one, the company's entry into the high margin certified pre-owned watches segment. The working capital requirements in this particular segment is much more lower compared to its existing business of selling new watches. And that should give a boost to the return on capital employed of the company. The second factor which will boost the margins of this business is the increased share of the exclusive watch brands portfolio in its collection. So that will also boost margins. Number three, this company is basically diversifying into rapidly expanding lifestyle categories like luxury luggage through the Remova brand and luxury jewelry through the Messica and Bulgari brand. So that will give a further boost with margin. And fourth point is that under the Trade and Economic Partnership Agreement, which India signed with Switzerland recently, the current customs duty of 22% on Swiss watches will be gradually phased out over the next 7 years, starting with a 3% cut in FY25. So this will give a further fillip to Ethos Limited's margin. So when you get margin expansion along with ROC expansion and revenue growth, then you get valuation re-rating in a particular company. And in light of all these factors, the current valuation at 40 times FY26 multiple looks fair. The improved earnings visibility, the improved longevity earnings growth of this business, and the expanding terminal value provide scope for further re-rating from here.
Okay.
No. All right. Okay. So Ethos, that explains your stance and why you like that stock as well. Got it. Gautam, good conversation as always. Thank you again. And we look forward to connecting again soon. Well,
Thanks for tuning in to CNBC TV 18, and for more news and updates, follow us on all the social media platforms.